Hi. Uh, Hello, everyone. This is Nitin from Zerodha, and I'll do a quick session on taxation when trading the markets. Uh, I think I mean I answer at least 20 to 30 queries every day on this. So I thought it'll probably be a good idea to kind of run this video and have a like a simple explanation uh, on everything about taxation when trading the markets. Right. So I have a sore throat, so so you'll have to excuse me if my voice is sounding weird. Okay. So what I'll do is I'll kind of run through, for all of you who haven't seen, it's the markets and taxation module on Varsity. So I'm gonna keep the same flow going, and I'm gonna run through each of the chapters, and I'm gonna talk about, and I'm also looking at all the queries that are sent to us that needs to be answered. So I'm gonna try covering as much as possible, right? So yeah, so let me start with the uh, first chapter. So the first thing is that I think uh, a- I can see that a lot of you, a lot of traders actually, who are out there get confused with a lot of these jargons that are used when trading and investing. So what I'm going to do in this session is I'm going to keep it as jargonless as possible. So I'm going to talk to you in as common language as possible, right? So the first thing, as in so is that everyone asks is should you file your income tax returns or not? Also what happens, I think, when trading the market, generally majority of the crowd might be sitting on a notional loss or a booked loss, and the query there again is uh, if I'm making a loss, should I even really bother about filing my returns? And one of those things that has happened in the last 1 year, uh, last 1 to 2 years actually, which makes it even more important for everyone to go declare the trading activity when filing income tax returns, is because like how banks share data with the income tax departments, and uh, you know today even jewelers are forced to share data with the income tax department. So like if you go buy a car, I'm guessing that the car showroom, the manufacturer is actually sending out your pan data to the IT department saying you bought the car, right? So similarly, what exchanges have started doing is exchanges are giving out trading data to to the IT department. So what it means is that if you tomorrow don't declare your trading income, the IT, it's a red flag for the IT department saying, oh, here's this person who's traded the market, but he hasn't declared. Right? And usually, how it is, right? As in, the first instinct of the department is to say, oh, he must be evading some taxes. Uh, so what's been happening over the last 1 2 years is the number of notices. I mean, I don't know how many of you have received it. This section, it comes with that 139.9. So those notices have gone up significantly. So I think I have a uh, let me just go back to the chapters. I think I have added a screenshot of a notice. Yeah, so here's that. So this is a notice, something like this, which IT department might send. It says non-filing of income tax returns, and this comes, I mean, firstly, I don't think there's anything to be worried about if you have received this notice, right? This notice is about asking that you have traded on the exchanges, and why is that not being shown on the income tax returns, right? So now, if you've traded and there's a loss, and that's because of which you have decided not to declare, so don't avoid replying to the ITO, because the more you avoid, the more you postpone replying. So the chances are higher that I mean, so once a notice is sent, there's a record on the database, right? So until the notice has a reply, that record is going to stay open, right? So avoiding is not really a solution. So what I'd suggest is, if anyone out there receives this, the first thing to do is to reply back saying the reason why it wasn't declared on your ITR. If there's a loss, send a P&L statement, you know saying there was a loss and I didn't know that it has to be declared, and that's why it wasn't done, right? So, and also, whatever I am saying, as I said, it's I mean, I'd always advise you to go consult a chartered accountant, because I think they are specialists in what they do. And so I'm going to try to make this simple for you, but then still, make sure to speak to a chartered accountant before you do anything around taxation. So Right. So yeah. So the first thing, as I said, the setting the context for this whole thing, the first thing to do is to ensure that when you're trading the markets, make sure you declare your income. Even if you're a loss, even if you're, say, even if, say, there are a lot of day traders out there, whose income slab might be less than 2.5 lakhs per year. That means you're making less than 2.5 lakhs, so there's no tax to be paid. But as a day trader, you've probably done a lot of trading on the exchanges. So when the income tax receives a notice like this, I mean, when income tax get data from the exchanges, they will see that there was a lot of trading turnover there, and then they will see your pan and see that you have not filed your income tax returns, right? So that automatically becomes a red flag, right? So even if you're under, you have no tax liability, nothing, just go out there and make sure that you fill an income tax return. Whatever ITR form it is, make sure you do it. Okay. And I'm gonna tell you, basic things to keep in mind while filing your returns, right? So yeah, so let me go to the first chapter. Okay. So the first thing that uh, question mark when trading the market is that, are you a trader or are you an investor, right? Now, because this has a significant impact on how you declare your income, how you file your income tax returns, right? Now, who's an investor? Investor is a person who invests into the business, as in, so you buy shares, so you're buying delivery stock. Okay, another thing, I want to set the context, right? So I'm going to keep it specific to investing and trading. So I'm not going to talk about, I'm going to, the entire session is going to be around equity markets and F&O markets only, right? So yeah, so firstly, as I said, so if you're an investor, if you buy stock and you hold it for a day and more, so it's called as a capital gain. So that means you're an investor, right? Because you're buying into the stocks of a company, right? Now, if you're day trading, if you're day trading stocks, it's considered a speculative business, because you're not really doing any investing when you're day trading. Day trading is considered as a business, and you're a trader. Um, so intraday trading in equity is considered as a speculative business income. Now, futures and options, be it intraday or if you trade futures and options and you hold it for a few days, it's considered as a non-speculative business income. Okay, and you're considered as a trader, right? Now, if you're doing equity delivery and you're doing some futures and options, you're essentially an investor in equity and you're a trader when it comes to uh, uh, derivatives and trading futures and options. Now, there's also another thing that you need to be very tricky about. If this equity delivery trades is the only thing you do in life, and this is your primary line of activity to generate income, now you cannot really show it as capital gains. So you have to show it as a business income itself. You'll have to show it as a non-speculative business income itself. So I'm gonna tell about this more in detail a little further ahead. But one of the good news the last year was that there was a CBDT circular. So the Central Board of Direct Taxes had put out a circular saying individual can have both a trading income and a investing income. That means I, as Nitin Kamath, could be buying stocks and holding it for like 10 years as a long-term investment, for which any gain I make is a capital gain. And in India, the good thing right now is that capital gains are exempt from taxes, right? So if you buy a stock and you hold it for 1 year and more and you sell it, any gain that happens, which is a capital gain, there is no tax to be paid. Now, if if it was not a capital gain, right, and if I was forced to show it as a business income, then I would have to pay taxes as per the tax slab I am in. So for example, if I'm in a 15 lakh rupee tax, if I'm earning 15 lakh rupees per year and I made 10 lakh rupees of this gain, and which I'm forced to show as a business income, I will have to pay 30% of this 10 lakh rupees or 3 lakh rupees as taxes, right? But the good thing about capital gains is that if you buy it and hold it for more than a year, there is no essentially no tax to be paid on that. And the circular last year said that that a single individual can have a long-term investing portfolio which can be shown as capital gains, as well as have a business income from the stock markets. Because until the circular came, there was always this gray area about can a single individual have both kind of portfolios, a trading portfolio and an investing portfolio, right? So now it's clear. I mean, you can come look at this module and click on the link, right? So quickly, I mean, I know I'd suggest all of you to go through the varsity module. I mean, I've taken, I think I've done I've tried to do a decent job in explaining it as simple as to keep as simple as possible all the explanations, right? So yeah, so when trading the markets, there are four kind of incomes you can make, right? a long-term capital gain, which is essentially, as I said, you buy something, buy a stock, and you hold it for a year and over. It's long-term. If you buy a stock, you hold it from 1 day to 1 year. It is essentially a short-term. If you buy a stock and you do intraday trading on it, it's a speculative business income. And if you're doing futures and options trading, or if you're doing very active equity delivery trades, it is called as a non-speculative business income, right? So sorry. So as I said, so I've given different examples on how to calculate. Now the short-term capital gain in India is 15%, right? So what it means is, if you buy a stock today and you sell after a month and you made a 1 lakh rupee gain on it, you have to pay 15% of that as taxes. So 15,000 rupees, right? Now the other thing about short-term capital gain is to remember is that if you are in the lowest tax slab, in the sense, assuming I don't have any other income, and I made this 1 lakh rupees in short-term capital gains, I don't have to pay any taxes. I don't have to pay that 15% taxes. So technically what it means is you get the benefit of the tax slab as well, right? So in India, the tax slab, I mean, I've given it here in this chapter here, so I've mentioned the different tax slabs, right? So 0 to 2.5 lakhs, 2.5 at 5, etc. Right? So what it means is that your short-term capital gain, the 15% kicks in only once your income is above 5 lakh rupees, right? So below 5 lakh rupees, if you're short term, you would be paying only 10 lakhs, if 10%, sorry, if your total income is in the range of this, or if you don't have any income, other income at all, so you don't have to pay any short term capital gains as well, taxes as well, right? So let me get back there. Okay. Right. So that's about short-term capital gain. I mean, speculative, as I said, is intraday trading. So any profit or losses that you make from intraday trading, you have to pay according to the tax slab you're in. So if I make like a 3 lakh rupee profit and from intraday trading during a year, and I am, my total income for the year is say 20 lakh rupees. So in the 3 lakh rupees, I have to pay 30% of that as taxes. So the other thing is, as I said, is non-speculative business income. Now, what's the difference between speculative and non-speculative? Speculative, is essentially, what IT department is saying is, is speculative is as good as gambling. So what IT department says is that intraday trading is equal to gambling. So other speculative business income, are like, if you earn out of, say, a horse race, or you go to a casino and you gamble and you win money. So all of this are actually considered as speculative business income, right? So non-speculative is essentially all your which is intraday trades, and you earn out of it. It is intraday equity trades, from which you earn, is all non-speculative business income. The good thing about non-speculative business income is that, if assuming you make a loss in this non-speculative business income, assuming you made a loss of, say, 10,000 rupees trading futures and options, and say you have a normal business where you made a 10,000 rupees profit, you can actually net off, and you don't, you reduce your tax liability on your, in your normal business side as well, right? So that's the good thing about non-speculative business income, is that, then your salary income, you can set this off against almost every other income, right? So if you have say, assuming you have a 50,000 rupees profit in futures and option trading, and you have a loss in some other business of yours other than salary, you can actually set it off and have to pay no taxes in either ways. The other thing a lot of people miss out on when they're trading the market is that it's very important to file your income tax returns on time. So when I'd say on time, it's usually July 31st or September 30th of every year for the previous financial year, right? So if you file it on time, you can actually carry forward these losses for up to 8 years. What it means is that if you have any FNO loss this year for, say, 1 lakh rupees, you can carry it forward to the next year, and assuming next year you make a 1 lakh rupee profit, you can set it off, to get, and then not have to pay any tax next year. If you don't carry forward the loss, what will happen is the next year on this 1 lakh rupee profit, if you're in a 30% slab, you'll end up paying 30,000 rupees in taxes. So it wouldn't make any sense to let go of any losses you've made. So I mean, see, that the business of trading, I've done this for a long while. It's a roller coaster ride, right? As in, but then I think, on a longer run, if to make money, you have to be smart about it. So you have to do the right things, and the right thing to do when you're trading is not to try ignore or try to forget the losses. The idea is to see how best you can use the losses itself to actually reduce your future tax outgo as well. So non-speculative this thing. Now, okay, so the pros and cons of declaring trading as a business income. So now the thing is, if you're showing your trades as a business income, right? As in, now futures and options, you mandatorily have to show it as a business income. There's no other option. Your equity delivery trades, right? You have an option to show it as either as capital gains, or you can show it as a non-speculative business income, right? So the thing about all of this, right, is that there is no rules written in written anywhere, right? So it's all sorry, so it's all it's all up to the up to you and your chartered accountant to figure like what to do with these rules. So I mean, you have both the options though. I mean, the idea is, if you're trading extremely actively in equity delivery, I'd suggest, you probably should show it as a non-speculative business income, because I mean, if you're trading extremely actively and this is the only source of your income, then probably it's a business of yours. So there was a recent ruling, I mean, you can Google for it, where I think Sachin Tendulkar, had this thing where the IT department actually put a notice saying, he shouldn't be given exempt from paying taxes, because he had shown as capital gains for a big source of his income, PMS income. But then the ruling went in favor of Sachin Tendulkar, saying that trading is not his, equity investing is just a small subset of multiple incomes he has. So he's got the freedom to show it as capital gains and not really as a business income, right? So so there's a lot of rulings in favor, but if this is the only thing you're doing, I think you should end up showing trading as a equity investing also as a business income, as a non-speculative business income, right? The good things about showing it as a non-speculative business income is that you can essentially, right from the internet that you are using right now to view these videos, to your mobile phone bills, which probably goes into into your business. So anything that you think can, that you're spending money on, which is helping your business of trading, can be added as a cost. So and then reduce it from either profits, or if it's a loss, you add it to the loss and then carry forward to the next year, right? So yeah, so I've kind of explained I mean all of this here, right? So um, it's quite straightforward actually, so right. I've also, what I'd also suggest is, if you have queries, actually go to the bottom of every chapter, and there's like, I think a few hundred queries at the end of every chapter, right? So this is about classifying your market activity. So as I said, you can either be a trader, or you be an investor, or be a combination of both trader and investor, right? So now coming to for investors, so this chapter dedicates only, it talks only about uh, you know how taxation works if you have only capital gains, right? So so as I said, I mean, any stock that you buy and you take a delivery of it, it's considered as a delivery trade, as in, so in turn you can show any gains made of it as a capital gains, so right. And like I was explaining earlier, the taxes are zero for long-term capital gains, if you're showing it, and for it's the same thing for equity mutual funds as well. And for non-equity or debt funds, it is a 20% on the gain with indexation benefit. So I've also given an example of indexation here. So indexation is essentially like, you're adjusting your return for inflation. It's explained here. I mean, because this is not about debt funds, I'm keeping it focused on equity, so I'm not gonna touch on that, right? So right, as I said, short-term capital gains on both equity and for mutual funds is 15% of whatever gains you make, right? Now, the other thing which is important here is, like, I think given an example here as well. I remember one of our clients, who sold a share, I think 360 days into the holding period. That means, see, for to get a long-term capital gain benefit, it's important that you hold the stock for 365 days, right? Because that's considered as a year. And then after that, if you sell, any gain made is no taxes, right? So for assuming, you have made a 1 lakh rupee capital gain, and you sold your stock on 360 a day, right? That means you actually have to pay a 15% short-term capital gain. So a 15,000 tax, which you could have easily avoided if you hold a stock, buying a stock and holding it for more than 365 days, right? So as I said, so it's important. So make sure that when you're selling your long-term equity holdings, keep a tab on how many days since you have bought it, right? And only then try selling the share. So if you're using Zerodha, I mean, we actually on Q under holdings, we actually show the number of days to the holding, so you can keep a tab of that, right? So okay, so other important concept is about uh, losses. So both this, when you make a loss, right, you can, as I said, it's important that you declare the loss, because you can carry forward a loss and then set off uh, these losses with future gains. I mean, like, a lot of my friends that I know who invest to trade, or even my father who used to invest, I mean, I've seen that when there's a loss, the idea is to say, oh, forget about it, there's no tax to pay. But a loss can actually be used for a future gain. So make sure that even if you have a short-term loss, that means you buy a stock today, you sell it after a month, there is a loss on it, you declare it, because you can actually carry forward for the next 8 years and set it off anytime you make a short-term profit in the future, right? Now, other important thing to know when you're investing is that if you have only investing, uh, so you only your capital gains income, you can use an ITR2 form, right? So I've mentioned here. So there are different kind of ITR forms, income tax forms, to be used in different cases, right? If you have only a salary income, you can use only ITR1. Right? If you have a salary and you have a capital gain income, which is essentially a short-term and long-term capital gain, in that case, you can use an ITR2. Now, if you're going to show your short-term equity delivery trades as a business income, as a non-speculative business income, you will have to use ITR4. ITR4 is used always um, to declare your business income, right? So now for traders, as I said, there are two kinds of business income. So if you are showing yourself to be a trader, you can either have a speculative business income and you can have a non-speculative business income, right? Speculative, as I said, intraday equity trading is considered speculative, and any form of F&O trading is considered as non-speculative business income, right? Now, taxation, when you're showing it as a business income, in equity capital gains, it was short-term was 15%, long-term was 0. But when you're showing it as a business income, you pay tax according to the tax slab you fall in, right? So if you're in your, say you're on a grocery shop, you're earning 5 lakh rupees from there, and you make 1 lakh rupees from trading F&O, you need to add 5 lakhs to this 1 lakh to this 5 lakhs, and then on 6 lakh rupees you have to pay taxes as per the slab you fall in, right? So the same thing with salary. So if you're earning a salary, so whatever is the income you make, you can add to the salary and then pay taxes accordingly. So uh, now, when you're adding this income, like I said, the good news about showing it as a business is this income is after reducing all your costs, right? So from STT, your brokerage, to your mobile phone bill, your Economic Times newspaper bill, to books you buy, to your laptop depreciation, you can actually use every cost out there that you have incurred towards towards your trading business. You could, like I've seen people who use a portion of their house for trading, and they even kind of sublet it from the main owner, so and show that the cost of the area where you sit and trade as a rental cost as well. So uh, you can get extremely creative with it. I'm sure you go speak to your chartered accountant, he'll give you good ideas on that, right? So yeah, so that's how you pay taxes when you're showing your business as trading. Now, again, as I said, you make a loss, don't don't just let go of the loss, because you essentially potentially can save 30% of any loss you make by carry forwarding and setting off for future gains, right? So one important thing to remember when you're when you're carry forwarding the loss is that you have to file your ITR, you have to file your returns within time. So if you file after the due date, you cannot the losses can't be carry forwarded, right? So if September 30th is the last date to file your income tax returns, if you file it on September or October 1st, that means that you will not be able to carry forward this loss to the future, right? So make sure to file your returns on time. So, right. So see, other tricky thing about this about income tax filing is that if you're making a intraday equity trade and you're making an FNO trading, say you're making a loss on an intraday equity trade, and you're making a gain on a uh, FNO trade, it cannot be set off, right? So that means, so if any intraday loss cannot be set off against FNO gains, right? So this is quite a tricky thing. I've explained it here, so I'd suggest you guys to read through it. But on the flip side, if you have made any FNO gains, it can be set off against if you have made any intraday gains, it can be set off against FNO losses, right? So when you sit with your chartered accountant, the thing is, a lot of chartered accountants I've seen don't really come like with a trading background. So I'd suggest you to read this and then probably show these links to your chartered accountant. So I've also given links to circulars wherever possible, wherever required. Right. So, but it's an important thing to do, because I've seen a bunch of notices clients have received where they have speculative loss against non-speculative gains, which is essentially your FNO gains, So, other very interesting thing to do, which I think I haven't seen too many traders do it in India, is this whole tax loss harvesting. It's an interesting concept. So let me tell you how it works. Now, say assuming you're sitting on some losses, right? So assuming you're sitting on some, say, short-term capital loss, so I had bought Reliance at, say, 1,000, I sold it at 900, I lost, say, 1 lakh rupees on this trade, right? Before March 31st, I have another trade on which I'm holding, so I'm holding, say Infosys, or or say Reliance itself. Okay, so I'm holding another trade where I have bought a stock on which I'm making a 1 lakh rupee gain currently, and today is, say, March 25th, right? Now, at the end on March 31st, I have this 1 lakh rupee loss that I'll have to carry forward, right? But like, a smart thing I can do then is to sell my holdings on, say, March 25th, book the short-term capital gain of 1 lakh rupees, and set off that 1 lakh rupee gain with this 1 lakh rupee loss, and not pay 15% tax, and then buy the same stock again after 1 or 2 days. So what I just did was, instead of carry forwarding this capital loss to the future, I'm using it to reduce any potential liability in the future. So essentially called tax loss harvesting. So that means if you have booked losses, you go and figure opportunities where you have non-booked gains, exit those positions, set off your gains against these losses, and then take fresh positions again. So right now, other question which is also like a contentious is this BTST trades, right? Which is, you buy today and you sell tomorrow. Is this speculative or is this non-speculative, is the question, because what is speculative is that, what exchanges, what the department says are speculative is that anything that you do which doesn't result in a delivery of a stock is considered as a speculative trade, right? So that's why intraday trading is considered speculative. So what happens when you do BTST, right? You buy today and you sell tomorrow, right? That means you never really took delivery of the trade, right? So if you never really took delivery of the trade, is this now an intraday kind of a trade? Is this a speculative or a non-speculative? So what we've done at Zerodha, I think you will have to go find out from your broker about this. But what we do at Zerodha is that when a person buys and sells the next day, we take delivery to the demat. So there's a DP charge put, so it's considered as a delivery trade. So we have taken care to ensure that this doesn't end up becoming an intraday trade for you, because it's always beneficial to have capital gains than have intraday income. So but you can find out from your broker how it does it. So because if there is no delivery charge there, it could potentially be considered as a intraday trade. But then, like I said, I am getting extremely technical on all of this, but what you need to know is the IT department probably doesn't really understand so much of technicalities. So I'm just explaining you this. Even if you don't care about it, you're showing any BTST trade as a short-term capital gain, go ahead and do it. Don't be worried about it. But just know the fact that if it is not coming to your demat, potentially in the future it can be considered as an intraday trade itself, right? Now, this is another thing which traders miss out on, which is advanced tax. When you're trading, it's like any other business, so like, if I am running the business of say of Zerodha, so every quarter I have to pay advance tax, right? So that means whatever I've earned, say from uh, April to say July, uh, April to June, I need to pay that in July as an advance tax, right? Uh, so potentially what advance tax is doing is, if you don't pay advance tax, what will happen is, if everyone's paying in this country taxes only after the end of the year, government is going to have no money to during the year then, right? So government will get money only end of the year every year, and they can't be like that, right? And also government will end up losing on a lot of earnings on the interest on this tax, right? So assuming, a business has a 1 crore rupee tax outgo at the end of a quarter, first quarter, and they pay only at the end of the year, right? So that means for the entire year, they, government potentially lost interest on that 1 crore rupees, right? So that's why, advance tax is mandatory to be paid when you're running trading as a business, not required when you're showing this as capital gains, right? I mean, so yeah, so make sure to pay that. If you're sitting on profits, make sure to pay it, because if you don't, the potential impact of an advance tax, if not paying, is that in the future you could pay the interest cost for the period for which you didn't pay the advance tax. So right, so not worth going through all that hassles. So I've given, as I said, uh, like links to, like a bunch of places where you can calculate your advance tax and all of that. So actually, income tax website itself is actually a really cool website. So if you can go spend some time there, it's got a lot of calculators and a lot of things that you need to know about. Okay. The other thing, which is very tricky, which I think we've kind of run a petition on as well, so uh, which is around this whole requirement of calculating turnover and the requirement of a tax audit uh, on your ITR forms, right? So now, this audit in itself sounds like a very threatening word. So firstly, I mean, I'd say, don't get worried, because I've had cases where, people have come and posted questions saying, I'm extremely worried on what is this audit and who's going to do this audit and etc. Okay, so here's what when is an audit requirement. Okay, what is an audit? Essentially, an audit is when a chartered accountant signs saying that he's kind of checked you out. So it's as simple as that. So audit doesn't mean that an income tax department comes to you and things. So audit just means that, instead of you filing your returns is also kind of vouched for by a chartered accountant. So what is kind of an anomaly though is that we've run a petition on this. I've approached multiple guys trying to get this thing removed. Is how audit requirement is determined for a trader is actually what is a little no is a big anomaly, actually. So see, audit is required according to the IT department if your turnover exceeds more than 2 crores, or if your profit is less than 8% of your turnover, right? So this was actually meant for normal businesses, people who run grocery shops, or people who run restaurants, and people who run all of that, right? For them, if someone's got more than 2 crores, the department wants the audit done, because it's a business, is a full-fledged business who's earning, whose revenues are 2 crores, right? So but in a business of trading, a person with just 1 lakh rupees in his account can potentially end up doing a lot of turnover, right? So it doesn't mean that this person uh, is like a restaurant. So firstly, so I think the first question you'll have is, what is considered as turnover? So let me clarify. I explained it in this chapters here, right? Uh, so there's like a big explanation I have, and I've got links to different places. So firstly, exchange the department IT department doesn't specify what is turnover when trading. Okay, when you're in equity investing or trading, there's a guideline by ICAI, so which has these few words, which says how to calculate turnover, right? So I've given the link here to the ICAI guidelines note, and then I've also put all the 4 points, on how different turnovers are calculated when you're doing differently, So now, the first thing is that this turnover is not your contract turnover. So firstly, understand that. So that doesn't mean that, you bought 100 shares at 1,000 rupees and you sold 100 shares at 1,000 rupees, 1,001 rupees. It doesn't mean you did 2 lakh rupees turnover. You could do it 100 times in the day. Doesn't mean that, it suddenly becomes like 200 crores, right? So what this turnover is essentially is like how in a business your profit or losses are turnover. So that's how it is in case of trading as well, right? So if you made a 1 rupee loss on this trade, or sorry, 1 rupee profit on this trade, which is 1 into 100 shares, 100 rupees profit, that 100 rupees is the turnover, right? So assuming the next trade you made a 100 rupee loss, so that is a turnover, right? So now your total turnover on 2 trades is 100 plus the 100 rupee loss, so it is 200 rupees, right? It doesn't become 100 minus 100 0, right? It becomes 100 plus 100 becomes 200 rupees, right? So that's how turnover is calculated, right? So it's essentially the profitability of every trade you do is turnover, right? When you're doing a delivery based trade, if you are and you're showing this as capital gains, there is no concept of turnover, right? Turnover comes into place only when you show yourself as a business, right? Turnover doesn't come into play if you're doing equity delivery trades and you're showing that as capital gains income. There's no concept of turnover there, right? But if you're doing F&O trades, if you're doing intraday trades, you're showing your equity delivery trades as non-speculative business income. In that case, you have to show all of this as turnover on the ITR form, right? So now again, turnover, I think the tricky thing here, is that how do you what interpretation you have of this turnover. Now, because I have to put this up on an online forum, where a lot of people read, I have taken the most least, say the most conservative approach to calculating turnover, right? So I think the tricky thing here is when you're trading options, right? Because see, when you're trading options, what it says is that premium received on the sale of option is to be included in turnover, and in respect of reverse trades, the difference also should be considered as turnover. So what it means is, right? So this is my least conservative interpretation, right? So if you bought an option, say one lot of 1,000 at paying say 10,000 rupees premium, and you sold it at say a premium of 11,000 rupees. The aggressive way of looking at this as turnover could be just 1,000 rupees, right? Like I said, profit of this trade, which is just essentially just 1,000 rupees. Now, a little more conservative or a very conservative would be to say, I will also include the sell side value, which is at 10,000 rupees, because the last line of this, which says in respect of any reverse trades entered, the difference thereon should also be part of the turnover, right? So, and it also says premium received on sale of options also turnover, right? So now I've given multiple examples here with different interpretations. I think care if I mean, it doesn't really care much for if your turnover is here or there, because there is no revenue outgo, right? And assuming you show a lesser turnover or you didn't get an audit done, it doesn't mean that IT department, Indian government is making lesser taxes from you. You are paying your taxes, right? Turnover is just to determine if you require audit or not, right? So you can take any approach actually. You can either take the aggressive approach of reducing your turnover as little as possible, or you can take an extremely conservative approach to show more turnover, right? But one thing I'd suggest though is that if you're doing trading as a business, trading is your primary thing, or you're very actively day trading and doing futures and option trading, so I'd suggest it's best to get an audit done. I mean, a chartered accountant acts as a sane check for you to ensure all that you're doing is right. So hopefully because of which no problems come in the future, right? Sorry. And then, as I said, there are multiple ITR forms which can be used to file income tax returns. So ITR 1, as I said, is if you have only salary. ITR 2 if you have salary, interest, income, etc. ITR 4 is when you also have to show your business income. When you have to show your futures and options trading, or etc., is when you have to use ITR 4, right? So I've also looked at all the questions that came through on the Google Forms, and I've tried to cover it here. Right? But then it's extremely tough to talk about such a wide topic in like 30-40 minutes, right? So please go through the module, and if there's any queries, go ahead and search for the answers. I'm guessing there must be something answered already, And if it isn't there, please go ahead and post it there, and I'll be more than happy to answer it for you. Right? And I think someone has asked me, if we can run a session on sample ITR form filling. So what I'll do is I'll try to get a chartered accountant to run this session for you. So where he will come and show how an ITR 4 form should be filled, because ITR 4 form is a little tricky. So I think it'll be a good idea to kind of run a session, like a 30-40 minute session, where the person can show you how ITR 4 form can be filled, right? So thanks a lot, and hopefully this made some sense. And if you have more requests on such videos, please go ahead and let us know about it, right? Thanks a lot.